The market is never silent. It says something every second, every moment. But do you understand its language? If not, this is the beginning of the knowledge that will take you one step closer to the world of trading. This language is the candlestick chart. Gregory L. Morris's book, Candlestick Charting Explained, is not just a list of patterns. It's a mental perspective that helps you read every breath, every pause, and every rise of the market. When someone first sees a candle chart, they only see some colored boxes and long, thin lines. But if you look carefully, each candle tells a story about how excited the buyers were that day, how fearful the sellers were, and which way the market was leaning. In this script, we're going to understand this complex but extremely powerful language in a very simple, realistic, and interesting way. So let's get started. Chapter 1, Part 1. What is a candlestick chart really? A candlestick chart transforms the data of the open, high, low, and close into a visual form. When you only see numbers, they feel like dry data. But a candlestick chart adds emotion to that data, such as whether the market is optimistic or fearful. Gregory says charts are the footprints of money. Each candle's real body and its wick and shadow tell us how the battle between buyers and sellers was fought. If the close is above the open, it's a bullish candle. If it's below, it's bearish. This means we can see which side won during that time. But the real magic happens when you don't look at a single candle in isolation, but compare it with the candles before and after it. Gregory emphasizes in this book that patterns only work when you look at them in context. That is the market in a trend or a range? What is the volume saying? And what was the history of the market at that level? So if you see a hammer, it's important to know what was happening before it. Otherwise, you might mistakenly think every long-wicked candle is a hammer. Now, let's talk about some basic but powerful patterns. The hammer and the hanging man look the same, but if the hammer comes after a downtrend, it's a reversal signal.
On the other hand, if the hanging man is seen in an uptrend, it's a warning that the trend may change. So it's not just the shape. Context is the real king. According to Gregory, the doji is one of the most intense signals because it indicates indecision in the market. That is, both buyers and sellers have become tired. If a trend has been going on for a very long time and then a doji appears, it could mean that fatigue is set in and the market could turn. But again, confirmation is crucial. That is, you have to see what the next candle says. In the engulfing pattern, Gregory says with great depth that when a candle completely swallows the previous candle, it's a strong signal. A bullish engulfing happens when a small red candle is followed by a large green candle, and a bearish engulfing is the opposite. But remember, size matters. Engulfing a small body is not a big deal, but a pattern that swallows a large body is much more reliable. Gregory's most important lesson is to never make a decision based on candlestick patterns alone. Always look at trading volume, support resistance, and trend lines together. For example, if a bullish engulfing happens at a support level and volume also increases, it becomes a high probability trade. This way of thinking is what turns a regular trader into a professional. Gregory also warns against over-analysis. Thinking that every candle is a signal can be the enemy of trading. Candles give an indication of a direction, not certainty. In the end, Gregory's book doesn't teach us how to conquer the market, but rather how to understand it and move in sync with it. If you learn this language, you won't just see charts. You'll hear the market's heartbeat. And when you start hearing the market's heartbeat, you become different from the crowd that just guesses.
Chapter 1, Part 2. Recognizing a pattern isn't enough. Understanding it is key. You've learned so far that candles are not just boxes on a chart, but they are the voice of the market. But Gregory L. Morris's real wisdom comes to the forefront when he says that just recognizing a pattern isn't enough. The real game is understanding and confirming the pattern. Now we'll dive into the subtle details of candles that can completely change a trader's mindset. Imagine you see a doji. You get excited and think the trend is about to reverse. But Gregory says, stop. A doji is just a possibility, not a result. If a strong bullish candle comes after that doji, then yes, it could be a reversal. But if the next candle also shows indecision, the market is probably still hesitant. This is where the role of patience comes in. In candles, patience means there's a background behind the signal. Just as a scene in a movie is incomplete without a story, a candle is incomplete without the story of price action. Now let's talk about a pattern that attracts new traders a lot: the morning star and evening star. Gregory puts these in the strong reversal pattern category. A morning star forms when there is a large bearish candle on the first day, followed by a small real body that shows indecision, and then a large bullish candle on the third day that completely negates the selling of the first day. This means the buyers are back. But Gregory's warning is the same again. Only consider this pattern reliable if it's at a support level, volume is increasing, and the broader market is also cooperating. This book repeatedly teaches you that no single thing is definitive. Everything together creates a signal. Just as every instrument in an orchestra comes together to create music, candles, volume, trend lines, and price context come together to create a trading signal.
According to Gregory, another common mistake is that people only focus on the color of the candle. Green means buy, red means sell. This mindset is wrong. The real issue is the size of the body and the behavior of the wicks. Is the upper shadow long? Is the lower wick short? Is the body larger than the previous candle? All these things create context. Now, imagine a candle with a very long upper wick, but a very small body. Gregory says this could be a warning. Maybe the price went up, but it was pushed back down, meaning sellers took control. It's these subtle hints that make a trader sharp. Gregory says something very special. Volume is the voice of the candle. That is, don't just trade based on the pattern. If a bullish engulfing has formed, but the volume is weak, it could be a trap. On the other hand, if there's a medium-sized candle, but the volume is very high, it's a real signal. So look at the chart, but listen to the volume. Morris also teaches that candles show short-term psychology, meaning the psychology of the market for 1 or 2 days or 1 or 2 hours. But you'll get long-term confirmation from the price structure. This is where the multi-time frame approach in trading comes from. You might see a hammer on a daily chart, but does the weekly chart support it? If yes, the trade could be strong. Another important concept of Morris is shadow analysis. He says that sometimes the real power of a candle is not hidden in its body, but in its wick, especially when you look at the upper or lower shadows in a sequence. If the lower shadows are getting longer on consecutive candles, it means that buyers are becoming active at the lower levels. This is a subtle signal of a potential reversal. And this subtlety is what differentiates a professional trader from others.
Gregory's book says that trading is not a game of guesswork, it's a game of observation and discipline. Now let's talk about the tweezer bottom and tweezer top. These patterns seem very simple, where the lows or highs are almost the same, but Morris says that their real power lies in their symmetry. For example, if the lows of 2 days candles are exactly the same and the second candle is bullish, it shows the firmness of the buyers. They are protecting that level, and if the volume also supports it, it can be a very strong signal of a reversal. Gregory says that the harami indicates a situation of indecision, where the market is taking a pause, but whether it will be a reversal or continuation depends on the next candle. If the next candle goes against the previous trend, it's a reversal. Otherwise, it's a continuation. Here, Morris teaches us discipline.
Don't rush to make a decision. Confirmation is the real power. He says that a successful trader understands the psychology behind the pattern. He doesn't just want to see a piercing line on the chart. He wants to understand what message this pattern is giving. Gregory talks about another dangerous mindset, the overfitting of patterns. This is when we start forcefully fitting patterns onto the chart. He warns that if you see a doji everywhere, you're probably not looking at the chart. You're just seeing your own thoughts. If you're wondering how to use all these patterns in practice, Gregory provides a framework. 1. Recognize the pattern. 2. Understand the trend context. 3. Confirm with volume. 4. Map the support-resistance zones. 5. Wait for the confirmation candle. This is the 5-step process that turns a new trader into a disciplined trader. A very powerful part of this chapter is Gregory's quote, "Your job is not to forecast, but to align yourself." That is, your job is not to guess what the market will do. You need to see which way the market is going and if you can align yourself with that direction. The biggest mistake in trading is fighting the market. And Gregory repeatedly says that pattern analysis only works when you work from data, not ego. Stay with the candles, not against them.
Now that you've learned so many insights, the question is, are you now looking at the market from a new perspective? Chapter 2, Part 2. Candles aren't data, they're emotions. When we learn to read candles, we start to feel the price. In this section, Gregory introduces us to the emotional side of candlesticks. Each candle shows a mindset, either the confidence of buyers, the fear of sellers, or the uncertainty created by the struggle between the two. Morris repeatedly reiterates that if you are making trading decisions based only on indicators and ignoring the candles, you are not understanding the market's language. Candlestick patterns tell you things that RSI, MACD, or stochastic indicators hide. They are real-time emotions. Now let's talk about a very important concept: engulfing candles. Many new traders get excited as soon as they see a bullish engulfing, thinking it's a perfect reversal. But Gregory adds a condition. This pattern only works if it's at a support zone, the volume supports it, and the previous downtrend is exhausted. Otherwise, it can also be a trap. A bullish engulfing is a pattern where a previous red candle is completely swallowed by a large green candle. Gregory says it's only real when it invalidates the previous price action. And even more importantly, the next candle also gives confirmation. If the next candle shows weakness or uncertainty, the engulfing won't be of much use. Similarly, a bearish engulfing is also effective only when it comes after strong resistance or an exhausted uptrend. Here Gregory says a powerful line: if the price was not already weak and then an engulfing is seen, it may be just a temporary pause, not a reversal. So, if the price was not already weak and a bearish engulfing appears, it might just be a temporary pause, not a reversal. Now that you've learned so many insights, the question is, are you now looking at the market from a new perspective? Chapter 2, Part 2. Candles aren't data, they're emotions. When we learn to read candles, we start to feel the price. In this section, Gregory introduces us to the emotional side of candlesticks. Each candle shows a mindset, either the confidence of buyers, the fear of sellers, or the uncertainty created by the struggle between the two. Morris repeatedly reiterates that if you are making trading decisions based only on indicators and ignoring the candles, you are not understanding the market's language. Candlestick patterns tell you things that RSI, MACD, or stochastic indicators hide. They are real-time emotions. Now let's talk about a very important concept: engulfing candles. Many new traders get excited as soon as they see a bullish engulfing, thinking it's a perfect reversal.
But Gregory adds a condition. This pattern only works if it's at a support zone, the volume supports it, and the previous downtrend is exhausted. Otherwise, it can also be a trap. A bullish engulfing is a pattern where a previous red candle is completely swallowed by a large green candle. Gregory says it's only real when it invalidates the previous price action. And even more importantly, the next candle also gives confirmation. If the next candle shows weakness or uncertainty, the engulfing won't be of much use. Similarly, a bearish engulfing is also effective only when it comes after strong resistance or an exhausted uptrend. Here Gregory says a powerful line. If the price was not already weak and then an engulfing is seen, it may be just a temporary pause, not a reversal. So, if the price was not already weak and a bearish engulfing appears, it might just be a temporary pause, not a reversal.
Now, another powerful pattern, the hammer. Gregory calls it the hope in despair candle. When the market is going down, everyone is selling in fear, and then a small candle with a long lower wick and a small upper body forms. It can be a signal that buyers have become active at the bottom. But again, the same thing. Not just the hammer. What does the next day's candle say? Did the buyers really take control, or was it just a pause? This is what Gregory teaches us repeatedly. Each candle alone is not the basis for a decision. Look at it in the context of the candles before and after it. Morris's next great insight is about Marubozu candles. These are candles that have no wicks, meaning there was full buying or selling pressure. If there's a bullish Marubozu, it means that buyers were in control all day, and if it forms at a breakout zone, it can be a signal of the beginning of momentum. But if this candle forms below a resistance, Gregory warns, just because a candle looks big doesn't mean you should jump into it. See if this candle has formed in the right place. That is, just because the candle looks big doesn't mean you should jump into that candle. See if this candle has formed in the right place, if it supports the trend, and if the volume is also strong. Now, let's move to the spinning top and doji. Many people ignore these patterns because they're small. They seem light, but Gregory says their power is in their uncertainty. The spinning top and doji say that the market mind is hesitant. Buyers and sellers are in equal strength. If these are seen after a strong trend, it could mean that the momentum has stopped. But again, Gregory always emphasizes one thing: don't just work with the pattern, validate it. Don't make the mistake of thinking a doji is a reversal until the next candle confirms it. Now, let's talk about gaps, meaning the price jumps from one level to another and there's no candle in between. Gregory calls these gaps windows. If a gap up is followed by candles that don't fill that gap, that zone can become a support. And if a gap down is followed by the price not going back near that gap, it can become a resistance zone. Gregory teaches that a gap is not just a price movement, but a burst of psychology. A gap up means buyers have built confidence overnight, and a gap down means sellers' fear is strong. But these can also be temporary, so look at the candles after the gap. Are they holding the gap or filling it?
Now that you've heard about so many patterns, think for a moment, how many times has it happened to you that you saw a strong candle and took a trade without thinking, and then the next candle broke that confidence? This is Gregory's most powerful lesson. Now let's talk about the market structure. Morris says that candles give a short-term view, but if you don't see them connected to the larger trend, you won't understand even 50% of their potential. So, connect the daily candle with the weekly chart, and validate the hourly candle from the daily chart. Only then will you understand the real confluence. And finally, Gregory says that a successful trader is one who can read the story behind the chart. Identifying the pattern can be done, but understanding its meaning is the real art. Now, after so many insights, you have reached a place where the chart is no longer just lines, but a language. Have you ever noticed why some traders are so confident when they have the same charts as everyone else? The difference is simply that they are not just looking at the candles, they are having a conversation with them. Gregory L. Morris says in this chapter that understanding a candle is just like reading someone's facial expressions. If you understand its language, if you recognize its gestures, only then will you know what the next step might be. This is why the emphasis in this section is on candlestick psychology. That is, understanding what emotion is at play in the market behind each pattern. Gregory gives a core message. Each candle is a behavior, and if you learn to read behavior, you can stand out from the crowd. He says that candlestick patterns are not static. They are live reactions created from the thoughts and emotions of thousands of traders. So don't look at them as rigid rules, but rather as an emotional reaction that tells you which way the market wants to go now. Chapter 3, Part 1. Recognizing a pattern isn't enough. Understanding it is key. First comes the rising three methods and the falling three methods. According to Morris, these are high-probability continuation patterns.
Their power is hidden within the structure. Imagine a strong bullish candle comes, then 3 small bearish candles appear, which are completely inside the body of the first bullish candle, and then another large bullish candle comes, breaking everything. Gregory calls this the consolidation of the buyers. That is, the buyers have taken a little rest, but they have not lost control. Similarly, in the falling three methods, sellers maintain complete control. These patterns try to tell you that after a pause, the same direction is about to come again. But Gregory gives a warning here. If the 3 middle candles move outside the range or the volume doesn't support it, this pattern won't work. Then, Gregory talks about another interesting topic, candle clustering. Sometimes you'll see many similar candles forming together on the chart. Dojis, spinning tops, small range candles. Gregory says that this clustering indicates that the market is in indecision and a big move is about to come soon. Such clusters often form before a breakout. So whenever you see strong candles consolidating in a range, be alert. Gregory's idea is that most traders ignore this phase because there's no excitement. But that's where the biggest advantage lies, without the pressure of preparation. Now comes breakaway gaps. These are situations where the market suddenly breaks a range with momentum and the price doesn't get filled in between. Gregory says that these gaps are created when a big news item, a volume spike, or a psychological level is broken. Breakaway gaps signal the start of momentum, but their most special thing is that these gaps are only real if they are supported by volume and the next few candles hold that level. Otherwise, it can also be a fatigue or a fake out. Gregory teaches that the best way to take a trade on a breakaway gap is to observe the first consolidation that forms after the gap. If the consolidation is narrow and the volume is light, the next breakout will be great. After this comes the advanced block pattern. This looks bullish, but Gregory says sometimes a reversal doesn't scream, it comes slowly, and the advanced block pattern is just such a subtle whisper. In this chapter, Gregory repeatedly says that candlestick analysis is not just about patterns, but about trying to understand the rhythm of the price. Each pattern tells a story, and you have to read that story in its context. Now think, when you see a doji, a hammer, and engulfing on the chart, do you see it like a tool or like a conversation? This difference will set your trading psychology apart. Chapter 3, Part 2, Correct Application, Correct Time. In this section, Gregory brings up a topic that most traders ignore, and that is the practical application of patterns. Gregory's strongest emphasis is that you have recognized the patterns, now learn to use them at the right time and in the right place. Gregory says something important here. In times of doubt, wait. In times of certainty, take action. That is, when the pattern is not clear or the context is confusing, don't take a trade. But when everything is coming together, the pattern, volume, trend, and support resistance, that's when you have to act quickly and with certainty. He explains the importance of the 3 white soldiers and 3 black crows patterns. The 3 white soldiers is a strong bullish pattern, where 3 consecutive bullish candles form whose close is higher than the close of the previous candle. Gregory says that if this pattern forms after a long downtrend, it's a strong reversal signal. But he also says that it's important to look at the size of the candles and the volume. If the candles are very large, it could be an overextended market, and a pause might come instead of a reversal. Similarly, the three black crows is a bearish pattern. Gregory says that if it forms at the peak of an uptrend, it's an indication of the seller's strength. But again, context is king. It's only a reliable signal if it forms at an important resistance level and the volume also increases.
In this chapter, Gregory talks about a new concept, gap filling. He says that the market prefers balance by nature. When a gap forms, there's a high probability that at some point that gap will be filled. But the important thing is when that gap is filled. If the gap is filled as soon as it forms, it's a sign of weak momentum. But if the price keeps moving in that direction for a long time after the gap forms and then the gap is filled, it could be part of a strong retracement. Gregory says that a gap being filled can be a trading opportunity. In this chapter, Gregory again emphasizes multiple confirmations. He says that a pattern starts a story, volume supports that story, support resistance gives the context of that story, and the trend shows the direction of that story. A successful trader trades by putting all these elements together. The most powerful lesson in this section of Gregory is, patterns tell you what is possible, but context tells you what is probable. That is to say, a pattern only shows a possibility, but when that possibility will become a reality is determined by the context. This mindset takes a trader from a game of guesswork to a game of wisdom. In the end, Gregory says that learning candlestick charting means feeling the heartbeat of the market. Now that you've learned so many insights, you won't just see the chart as data, you'll talk to the market. Gregory's strongest focus is that you have recognized the patterns. Now learn to use them at the right time and in the right place. Candle analysis is not magic, it's a method. This means no single candle can tell you about the future, but if you use it consistently as a method, then this candle can keep you ahead. Now you're reaching a realization where the candle is not just showing you patterns, but is becoming an open document of a trader's psychology.
Chapter 4, Part 1. Gregory begins this section with a great observation. A candlestick is like a word. This means that if you try to derive the meaning by looking at just one candle, you're missing the whole story of the market. So the question arises, how do you read the whole sentence? The answer is trend structure. Gregory says that you can only understand the true power of a candle when you read it in the context of the trend. Higher highs, lower lows, retracements, and breakouts. For example, a bullish engulfing candle that forms in the middle of a downtrend might just be a short covering bounce. Gregory teaches a system he calls structural confirmation. That is, any candlestick pattern should be considered credible only when it aligns with the trend structure. 3 core trend phases. Now he introduces us to the 3 core trend phases: accumulation, markup, and distribution. He says that the behavior of candles is different in each phase. Accumulation phase. In this phase, you'll see many dojis, spinning tops, and small range candles. This means that a balance is being created between buyers and sellers, but buyers are slowly becoming stronger. Markup phase. In this phase, the bullish candles are large and decisive. You'll see consecutive higher closes, and the pullbacks are small. Gregory says here, look for candles that bounce back strongly after a sharp fall. Distribution phase. In this phase, indecision becomes dominant again. You'll see many upper wicks, which means that buyers are no longer as confident. Candles like bearish engulfing, hanging man, and shooting star become more meaningful here. High-value setups. Gregory teaches a very important concept. If a hammer candle forms at a support zone or at the end of a downtrend and it forms after a strong fall, Gregory considers it a high-value setup. But if the same hammer forms in a sideways market or a random zone, Gregory calls it confidence in the wrong place.
Trader's trap, over-confirmation bias. He now talks about a trap that 90% of traders get stuck in: over-confirmation bias. This means that when you look for a specific pattern on the chart and find it, you ignore the rest of the context and take a trade relying only on that pattern. Gregory considers this a common trap. He teaches that a good trader always questions the pattern. Is this pattern in the right place here? Does this pattern support or contradict the preceding price action? Volume analysis. Now let's talk about the combination of candle psychology and volume analysis. Gregory says that even if a bullish candle looks big, if the volume is low, its confidence is weak. On the other hand, if a small candle is formed with high volume, it indicates indecision or a fight. Gregory encourages you to ask yourself these 3 questions every time you open a chart. What does the current structure say? In which zone is the candlestick pattern forming? How does the volume support this picture? This way, you'll be able to see each candle not as an isolated tool, but as a complete setup. This is the biggest lesson of this section.